thank you everyone for joining today. So my name is Rushi Shah. I'm VP of Product Management here at YCharts, and I am really excited to be joined by two of my favorite people in the industry, Michael Batnick and Ben Carlson from Ritholtz Wealth. And they are also the hosts of the Animal Spirits podcast. So Michael and Ben, welcome to the show.
We're excited to be here.
As am
Me more
I.
so than Ben. Me more so than Ben. He didn't even say anything.
I was letting you speak for us.
I think Ben's excited too. All right, just some housekeeping items before we get started. At the bottom of your screen, we are on a Zoom webinar, so you should see that Q&A. Feel free to throw questions in there throughout the webinar. We'll try and get to some of them throughout the show. Also, if you are on the call or if you are registered, we will be sending you a recording of this webinar as well. And in that email, we will also send you some ways to get some of the charts that we're going to be covering today. So you'll have some of those charts within there to access within your YCharts account. Also, feel free to subscribe to our YouTube channel where you can get great content just like this webinar and other types of trainings and things like that that we have on there. And lastly, please keep in mind that today's webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. So with that, let's get going. So today we're going to have some fun on this webinar. It's the end of the year. We want to cover a few different things. One is we'll start with some predictions that Michael and Ben covered towards the beginning of this year and see how they fared. We'll also go into the topic of the market in general. So we'll have some market related charts. Then we'll talk about the economy. Then we'll talk about a little bit of what's next, what to expect in 2024, and then we'll answer a few questions as well. So let's get going with some market predictions. And Ben and Michael, I know it's hard to be 100% correct. So let's go through a few of these predictions.
Wait, hang on. The year's Russia. The year's not over. I got 24 days.
Yeah, I mean, maybe some of these will turn. Let's take a look.
The thing that I learned about predictions, though, is that you just make a lot of them, and a couple of them are bound to come true, and then you get media attention, which is what Michael did. It's a great strategy.
Well, that's kind of how these are too. We have a few that maybe aren't so right, but there are a few that are. So
wait, hang on. Wait, whoa. I have to defend my honor.
You did pretty good.
I did do pretty good, but what Ben's referring to, and this is not a deliberate strategy. One of my silly predictions was that Jeff Bezos returns to Amazon, and I believe I hijacked that from Ben.
You definitely did.
That got you on CNBC, right?
But yeah, that was just a throwaway. That was the dumbest prediction of all. I was kidding. And the Hollywood Reporter reached out to me at CNBC, and it blew up, and I caused a bit of a stir in Amazon from this nonsense. So maybe I'll try it again next year. I don't know. I should dial it up even more.
People love predictions, I think, and this is a fun time of year to do them.
Exactly.
All right, Rishi, let me have it.
All right. Well, let's take a look here. This first one is the question of value versus growth. I think, Michael, you predicted that value would outperform growth. I'm actually going to change this to a total return chart. Let's take price off there, and looks a little bit like the opposite, actually. Growth has quite outperformed value. What are your thoughts here, Michael?
Not only has growth outperformed value, I was right on this prediction for it looks like a total of 3 days. For the first 3 days of the year, value. All right, so the deal was that it's kind of interesting if you think about it, or at least where the narrative shifts. So the deal coming into this year was that tech was in a recession, full on. If you look at this charts, there's a site layoffs.fyi. I don't know if that doesn't sound well. Whatever. There's a chart that tracks tech layoffs or industry layoffs, and everybody in tech was laying off employees. Facebook obviously did a lot of cutting of the fat. Microsoft, Amazon, I legitimately think they all did. And those companies got destroyed in 2022 for various reasons. But at the epicenter of that was interest rates, right? Like discounted cash flow, LOL, but seriously, the cost of capital mattered, and those companies got lean, and they got the memo. And I just did a post using YCharts data. The fan mag trade bottomed on December 28th, 2022. and a 48% drawdown. And Ben, this is a topic that Ben and I have been talking about in the podcast, Animal Spirits, that you can't talk about 2023 without talking about 2022. So,
well, Rushi, show the growth and value in 2022 because it was the exact opposite.
Exactly. So
Yes.
in so many different areas of the market, 2023 is a complete reversal of 2022. So I think the story in 2022 was pretty clear. Higher interest rates were going to hurt growth stocks. Maybe they were saved by the AI trade. In fact, I think that's not a maybe. Certainly, that was a huge.
Well,
huge
the thing
tailwind.
is, to Michael's prediction, the macro stuff. If you look historically, higher rates and higher inflation is typically bodes much better for value stocks, and I think that's what happened in 2022. And rates did continue to move up in 2023, and inflation was still high, but growth stocks still work. So, like macro wise, value would have been the right call, but growth stocks didn't cooperate, and neither did value stocks.
But here's where narrative follows price, because in 2022, obviously growth stocks are going to get killed, and obviously companies that are cash flow positive today will get rewarded when the cost of capital goes up. That was a very clean story, and it worked. And then as the price did what it did, their narrative shifted in 2023 to, well, of course value stocks got killed because, if Coca-Cola is competing with U.S. Treasuries for investors' attention, why would you take a 3% dividend yield and equity risk when you could just get 5% risk-free? And so it's the same exact thing, except the only thing that's different is the price changed and then the narrative changed.
Yeah, definitely. It's definitely a complete reversal of what you look at when you look at this chart from 2022. So makes sense.
Now, can you show it? Wait, real quick. Show the total returns from the beginning of 2022 and see shake out. It's got to be pretty close, right? Yeah. So over the 2-year period, they're basically even. So you've had a reversal, but they've kind of gone different directions, but now we're end up in the same place.
Ben, do you think this is a case for diversification?
It's not. I mean, if you would have rebalanced these after 2021, you would have been selling growth, buying value. Then after last year, you would have been buying or selling value, buying growth, and it probably would have helped a little bit.
Kind of conforms with the general volatility of growth, right? Where you're going to have more swings, but potentially the outcome could be relatively the same.
What else did I get wrong?
All right, this one was this one was Ben. Ben mentioned how there would not be a market correction in 2023. And I believe the definition.
He didn't say that.
Did I say that? I don't remember that.
No, there's no way he said that. That's not. I know Ben Carlson, and that's not a Ben Carlson quote. No way. I was there.
It was something along those lines.
If it was right, I'll take credit. But I don't know if I would have said that. But I'll take credit for it.
Ben Carlson is every year there will be market corrections, and 2023 is no different.
We'll find the exact blog post where we got that.
You're not going to find it.
But in general, I mean, this chart right here shows that we just shied away from that negative 10%, I guess, definition of a market correction. So, I mean, all in all, in the markets, does this surprise you that we dodged even a 10% drawdown in the markets this year?
I think we showed on a price basis we did, but
I'm not surprised because if you look at one of my predictions that you conveniently didn't include, Rishi, I said as a bonus prediction, the market avoids a recession and stocks gain double digits.
So I think the number for double-digit corrections in a year is like 2/3 of all years since the 1920s have had a double-digit correction at some point, like a peak to trough. So it's probabilities are in your favor if you do predict one. But yeah, one third of the time it doesn't happen. I think technically, if we're going on price, though, it happened.
It did, yeah. From a price standpoint, it got down past that 10% value.
Just barely.
So. All right, next one here. This is Michael. This is one you got right. So you had gold making all-time highs, which I think it's pretty much right there. We have this chart, which is gold in U.S. dollars, in Japanese yen, and also in Canadian dollars. So it just kind of shows different currencies have obviously different impacts on the gold price. But why, I guess, is gold at all-time highs? What are your thoughts on it with where the markets are?
It's very simple. I have 2 words for you: fiat debasement. I don't know. I don't know which. Ben, go ahead.
This is another weird one macro-wise, because usually there's a inverse relationship between real rates and gold. And if real rates are rising because gold doesn't pay a dividend or income or anything, that's when gold tends to struggle. And when real rates are low, that's when gold should do well. And this year has been the opposite because real rates took off and gold did too. So I think it is more of a, to Michael's point, maybe it is more of a macro, people are worried, some sort of hedge against the US government kind of deal, because the financial relationship you would assume didn't really hold this year.
Yeah, but of course that doesn't make sense, because if there was macro worries, why would the stock market be at all-time highs?
True. Don't you think most gold investors though are kind of on an island in most cases? That those are the people that are really worried about the Fed and government spending and government debt and that sort of stuff.
Yeah, but they're always worried about that. I don't know. Maybe not everything needs a narrative. Maybe it's just going up because it's going up. I don't know. Is there a scientific reason why gold is doing well this year?
I don't have one. Jewelry sales are up.
There we go.
People are spending money, I guess.
I'm sure there are stories out there to
But you're right. There isn't a really even good narrative for it though.
And guess what? The dollar's been strong all year too, for the most part. It's not like the dollar. It's not like gold is going up because the dollar's going down.
True.
That could be it. And then the last one here, Ben, this was you. You talked about how the market won't have an average year, right? So your point you made on your blog post was, even though the market on average is around 8 to 10% growth, the variance of that is pretty high. And so I think only 20% of the time, going back to 1950, that was the case. And this year we're looking at around 20% growth right now in the S&P 500. So I guess, how do you think about this as an investor if that's your expectation to grow 8 to 10%, but there's a lot of variance there?
Well, one of my favorite quotes or stats is, you've been more likely historically to have a up 20% or more year than a down year in the stock market. And I think that's the kind of, that's the kind of thing you have to expect, like a really good year or a bad year. And you're not just going to get 8 or 9% every year. That's very rare to have a 0 to 10% return. So I think you do have to prepare yourself for the wide swings and the wide ranges. But when stocks do well, like they are this year, this isn't an outlier. This is kind of the norm.
Yeah, definitely. We'll get into some charts that show.
That's a pretty good Christmas tree looking thing too, right? It looks like a Christmas tree.
Yeah, it does.
It's the season.
But wait, just if somebody's eyeballing this and saying, well, what Ben just said doesn't make any sense. I think, Ben, your stats went back to 1926, right?
Right. Even this has got to be pretty close, but yeah, over the last 100 years, but this is since 1950. There's a decent amount of 20% up years, obviously, and double-digit up years too.
Yeah, definitely.
Yeah, that's wild. So even this alone is 2, 4.
But look at that. Look at the left tail. Look at all the plus 20 years. How many down 20 years are there? There are 20%. So there's 3 years that are down 20% or worse. So that situation doesn't happen very often.
Since 1950, there's been 19 years that gained 20% or more. 19 years that gained 20% or more, and only 20 years that were negative. So
yeah,
to Ben's point, pretty good. I'll take those odds.
Yeah. I guess that's the risk that comes with it, but it also comes with reward. So, all right, cool. Well, those were the predictions. Let's jump into the markets and talk a little bit about these charts. So the first one, which stocks are within 10% of their highs? So we're going to use our stock screener here to do this. I'm just going to add a filter. This is for the whole Russell 3000. So let's just look at percent off all-time high and greater than negative 10%. And here's our list of stocks. It goes from 2,600 or so that are in the Russell 3000 down to only 337. And I'll just add a few extra columns here to talk through.
That's a lower amount. So that's a lower amount than I would have thought.
Which number?
So 300 out of 2,600 or within 10% of their all-time highs?
Yeah, but a lot of those are shitcos.
I'm saying I would have thought it would be more companies, since the stock market itself is almost back at all-time highs. I guess that's the whole narrative of bigger stocks winning.
Yeah. Well, so like sort by market cap, for example.
Apple, Microsoft,
So you've
Nvidia,
got
yeah.
yeah, we've got $3 trillion companies on here.
Does
Look at
that
Warren
does
Buffett
that
sticking with those tech stocks.
does that concern you at all? That, I mean, you look at this, it's probably what, about 15% of stocks are within 10%, whereas the markets are pretty close to all-time highs.
Michael's ready to get bullish for 2024 on the rest of the stocks.
That's right.
2024
Yeah,
is the year of the 493 or an equal weight, right?
it's 2024 is gonna be the year of the 493. No, Rishi, it doesn't concern me because the Dow, which is just a weird price weighted index, literally like the share price determines the weight in the index. So what's the biggest stock in the Dow?
The Apple, right?
No,
United Health. I would never would have guessed that.
Oh, from a weight standpoint.
United Health.
Yeah.
The Dow is at an all-time high. So it's
Total return basis, right?
Market cap weight is definitely doing funky stuff to the indexes. That's been the story all year. There we go. United. Yeah, this is so weird. Goldman and Home Depot and McDonald's are top, and Amgen. What in the world? But nevertheless,
I never would have guessed that in a million years that United Health is the biggest company in the Dow.
Yeah.
Yeah, because of the price weighting, right?
Right.
So in a bull market, these divergences tend to resolve themselves to the upside, which is what we saw earlier in the year, and it's what's really played out all year. Rishi, pull up RSP if you don't mind. The equal weight S&P 500. I'm guessing this is up, like last time I checked, this is up 7% year to date. So obviously lagging the cap weighted index pretty significantly. In fact, historically so. But it's not like I would be concerned if the RSP was down 8% and the S&P was up 20. I would say, okay, this is not good. Because when the Giants roll over, when they catch down, we're in big trouble. But in a bull market,
yeah, it's still up this year.
Bulls have the benefit of the doubt, and my hypothesis that I'm still workshopping, it's still baking in the oven, is that 2024 will be the year of the catch-up trade for the 493.
And just like the value versus growth, equal weight did better in 2022 than the big, huge ones, and then it reversed in 2023. So it's kind of a similar story.
Whoa! What is this full year thing? This is new to me. Is that a new button?
Yeah, you could just pick the full years you want to look at on the chart rather than having to put in like a custom time frame.
I have to admit, I have not seen that either. I have not done it before.
How have I never asked you for this? Because I ask Rishi fairly frequently for some product upgrades. This is obvious.
There you go. It's in there already.
So you can change from date range to full year. I honestly have never done this before.
Because I do that all the time manually. It's annoying. Wait, is this a new feature?
No, it's been out for a bit.
Really?
Yeah.
Huh. I'm not very observant. I am not very.
That's
observant.
on us. That's on us, Michael. Neither of us knew that.
If my wife were hanging picture, that's a bad example because we're not art people. I don't even know that I would notice it.
It is.
One of my many flaws.
We snuck it in there. So I guess to your point, Michael, you talked about the Magnificent Seven, and you had this chart where it shows the growth of the Mag 7 versus the rest of the S&P. So what you're saying is you see the rest of the S&P kind of catching up here moving forward.
That's exactly right. The S&P 493 will gain 100% in 2024. The stock market will. No, I'm kidding. But did you also pull the 2-year chart for this? Not that it really matters. We already discussed that. But I see a catch up rather than a catch down.
Makes sense. All right, next one, and I guess this is on the same point, and this is a chart that shows the top 10 holdings in the S&P 500 back in 2000 and what happened 23 years after that. And then we also have another chart I can show you on 2005.
Wait. Just stay with this for a second. This is a really interesting chart. What stands out?
So this is like GE and Cisco and those kind of stocks, probably.
Exactly. Yep.
One of the things that stands out to me here is even when the bubble burst, the top 10 tracked the S&P for the next really the next decade. It wasn't until the bottom of the GFC that these two lines really started to separate dramatically, right?
That's true. For the lost decade, they actually held up okay.
And the one stock that is also in here is AIG, which
Yeah.
Oh, wait, that was the
Probably
top 10 stock in 2000?
Citigroup
Yep.
too, maybe. Citigroup might have been close. So some
Yeah.
really huge dogs in there.
Right, and the GFC, yeah, they didn't recover. That's right. Good call, Ben.
So you made this list on your own then. I assume you made this as a portfolio.
yeah, so this is an equal weighted portfolio of these holdings. These were the top 10 holdings back in 2000. So you have Exxon, Walmart, Pfizer, etc. But yeah, Citigroup's in there, AIG's in there.
Yeah, GE was a dog.
So
That's interesting.
if we're looking at this chart, I guess in thinking about right now where the Mag 7 is, and those are technically those are the top 10 holdings or 7 of the top 10. Does this pattern continue? Is that something that people should be keeping an eye on and see if there's other leaders that come up and kind of outperform those Mag 7?
I would say the only thing you could say is like 2 or 3 of the top 10 right now are going to underperform by a wide margin over the next 10 years. That's the only thing feel safe saying. I think anyone betting against these huge tech stocks, I think they've already run for longer than anyone would have thought possible. People were saying that this stuff was a bubble in like 2015 already, and there was still another 2 legs up from there probably.
I think the intelligent, I'm using air quotes, answer to give here is, of course, the Mag 7 are going to underperform. Look at what they've done for the last 5 years. And I feel like that's like the nitwit brain. And hand up, I'm a nitwit. I think it's probably easy to say that. But I wouldn't be surprised if these companies are ultimately $3, $4, $5 trillion companies. Maybe it is different this time. Maybe these leaders are so deeply entrenched into every facet of our lives that these are not the Ciscos of the world, the AIGs of the world. I don't think it's impossible that we're having this conversation in 10 years from now that these stocks are still outperforming.
I think the best argument against these stocks for the past decade has been like, what if the government steps in and regulates them as monopolies? And it just doesn't seem like anyone wants that to happen. Consumers are happy with Amazon and happy with Google and happy with Apple. It doesn't seem like there's a lot of groundswell to break them up for any reason.
That makes
I
sense.
think that Amazon, Apple, all have monopolistic characteristics in a good way. I don't think you could say the same thing about NVIDIA. And I don't think
Apple has a monopoly of my desktop. I have a Mac, AirPods, Apple Watch, iPhone.
And now I'm not even talking about the products. I'm really talking more about the store than anything.
Yeah, that too.
But I would say that NVIDIA does not have the same moat that these companies do, and Facebook doesn't either, in my opinion.
Makes sense. And if you're a financial advisor and you have clients where, if they have a portfolio, even if just the S&P 500, they're pretty highly concentrated in these 7 stocks. What do you tell them? Do you tell them, hey, I mean, you're in the market and that's okay, or do you have them diversify away from that?
Our advice is that you own the S&P 500 and you short the Mag 7 individually, so you're fully hedged. No, Rushi, you make a good point that people might feel some sort of FOMO that they're underexposed because they don't individually hold these names. Oh my gosh, NVIDIA is up 300% or whatever it is. How do I not own it? I know you own it. You own it very well. And the beauty of an index fund is that the winners win and the losers fall by the wayside, and it's sort of a natural rebalancing mechanism. You don't have to worry about any of this. Who's going to be the winner? Who's going to be the loser? The market sorts it out for you.
And there are a million different strategies you can invest in these days. And I think if you're looking at just a regular index fund or the S&P 500 or even the NASDAQ 100, which is the S&P on steroids, that beta large market cap has periods of underperformance. It happened in the first decade of the century where small caps did better, bonds did better, REITs did better, all these other asset classes, value did better. So it's not like we've never seen that before. It can underperform. So I think it is prudent to diversify outside of that, even if it's been a painful experience to do so over the past 15 years.
Yeah, all jokes aside, that is how we view the world. That we don't want to be all in on any one asset class, any one style, any one strategy or sector or anything like that. And we don't want to be all in on the S&P 500. It's can't avoid it. Been a great place to hide out, great place to be exposed to, but you should not expect the returns of the last decade to go forward for the next one. And if you're wrong and they do, wonderful. But if they don't, there are other areas of the world that have underperformed for a long time that are cheaper for very good reasons, but you don't know what the future holds. So better to not put all your eggs in one basket.
That's the good news. If you are someone who is really worried about the Magnificent Seven, and there are people who are like that, and they're so overpriced, and there's no way they can keep this up. There's plenty of other places that you can go to diversify that are way cheaper. If that's your criteria, is valuation.
Yeah, margin market value. Take as much as you want. Nobody wants them.
True.
Makes sense. All right. Let's move on. I guess we kind of talked about value versus growth. The one point I wanted to make here was the discrepancy between small cap value and small cap growth and large cap. Maybe we could just touch on the small cap side of things here and how they tracked pretty closely. Is there a reason for that?
I assume the difference is, can you see what the sector weightings are? I'm guessing small cap growth just has a smaller allocation to tech, or tech is just not doing as well in small cap growth. Because yeah, that's obviously way closer.
Yeah, so when you look at this,
can you show us the holdings to overlap tab? What does that look like? Or is that not useful for what we're talking about here?
It basically shows you the underlying holdings. Like if you had a portfolio of just mutual funds or ETFs, it'll give you the actual stocks that you own.
So tech is 25%. So that's actually higher than I would have thought. It's just that those smaller tech stocks aren't holding up as well.
Rushi, if I could allow you to flex a little, are you able to do a side-by-side comparison of two funds, like sector analysis, or does that tool not exist?
You can. You could do it via a report. We also have this quick flows tool, which is pretty cool. So if I wanted to just take all these out and do IWO versus the
IWN,
also 2000 value. And then you could do a sector exposure comparison, and it builds out a table for you to take a look at the differences.
Beautiful.
Oh, that's great.
So, I mean, it's tech and healthcare,
but it's just that I guess the small cap techs. I mean, how many of the small cap tech stocks could you even name? Probably not very many, right?
No. And then also real estate. Real estate was a drag, obviously, on the value portfolio. Very cool.
Yep. All right, next up on the list, asset class performance. So we have this in our econ summary deck, but it's that quilt chart view, if you will. And basically, this is just showing you different asset classes over different time frames. So any thoughts here on the year to date, which is growth outperforming the rest, versus like a 10-year view, or what are some things that you're noticing here?
Bonds have had a pretty
and this is all you.
Well, bonds have had a pretty tough 10 years, obviously, right? Bonds are 1.5% over 10 years. We've been talking about growth and value a lot. U.S. value has been up 8% per year. That's not terrible over a decade. I know it's nothing like growth did, but it's okay. It's not as bad as some people would assume.
My eyes, I can't even see this.
Zoom in a bit.
There we go. Thank you, Rushi.
Commodities negative over 10 years is interesting. I guess that the crux of growth doing well, which is technology, and commodities doing poorly, those are kind of two sides of the same coin, I guess, or the other side of it, because technology has done well, and I think technology hurts commodities over the long run, which is that 10-year thing is painful because, like, I guess maybe it was more in the 2000s around the crisis where so many advisors, I think, jumped into commodities because they had such a great run there when emerging markets were doing well, and the commodities have struggled, and that's inclusive of a 40-year high in inflation. So you've had that one good year of commodity run that obviously didn't help that much.
Ben, if you're a betting man and we can't go back in time, what sort of odds would you have needed, plus how many hundred, to put money on the fact that the S&P 500 could finish 2023 up 20%. Plus 700? And what I mean by that
No,
for
that
the non-bettors is you put $100 on the line. How much money do you win? So you bet 100, you win 700. Like what would?
no. After a down year, Vegas would have given you minus odds on that.
What? To be
You don't
up
think so?
20%? To be up,
I just said.
Are you on drugs?
I just said it happens all the time. You'd have like even odds on that.
How much? You're nuts.
For a 20% gain, I told you it happens all the time. You don't think so?
All right. Rewind to the end of 2022. You would have bet even money? What are you, crazy?
The stock market had a bear market in 2022. You'd expect a snapback. Right. It's easier after a bear market.
If you're not going to be honest with yourself, I don't know what we're doing here. Rishi's not being honest.
Is that a Grand Rapids hedge right there? Or I don't know.
That's exactly what it is.
That term exactly.
If you're going to give me plus 700 odds, I would take that every single year because I'd win a lot of money over time, probabilistically.
That's a fair point, but things were looking pretty dicey. My point is things were looking pretty. Ben doesn't want to play the game. Things were looking pretty dicey coming into 2023.
Okay. I get what you're saying. A lot of people were very bearish and thought things were only going to get worse after a really bad year. And the funny thing is, I actually looked at this. History shows after like the worst years ever for S&P 500 or a 60-40 portfolio, the next year is either really good or really bad again, with not much in between. But the good years outweigh the bad ones. Fair. I get what you're saying, Michael. You tried to lay that one over the plate for me, and I just wouldn't take it.
All right. Well, the last
you know
one
what
on
I was
this
doing.
topic.
You know when you're playing basketball, and you're like.
Yeah, I wasn't taking it.
Put the person where to go. Ben wasn't cutting. All right.
Ask him to pass it the other way. All right. So this one is the 60-40 portfolio. Big topic, I think, in 2022 is the 60-40 portfolio dead. Year to date, it's up 13%. Any
what did you build
here?
This with, Rushi? What did you use to build the 60-40?
So this is the S&P 500 total return and the Barclays
and the
US aggregate total return.
Look how fast things change.
Yeah, it was. I mean, 2022, I think by my count, was like the third worst year ever for the 60-40 portfolio. So in the bond piece was probably even harder to stomach than the stock piece because you had bonds down double digits as well in a year the stock market was down double digits.
Look, and a lot of people were saying bonds down 13%.
Yeah, and a lot of people were saying, okay, 60-40 is dead. But look at those years before 2022. So you had a really bad year in 2022, but you had 3 years in a row above 15%. So you had an amazing run into 2022. Yeah, you had a great run. So the 60-40 portfolio. So what's the 10-year number say? 8% or whatever. That's basically the long-term average, which I think is still too high for people to expect going forward. But over 10 years, inclusive of one of the worst years ever for the 60-40 portfolio, you still did pretty well.
Hey, Rishi, go back to the line chart, please. On the previous screen. Yeah, here we go. So when I said it's amazing how fast things change, rewind all the way back to like 5 weeks ago. Look at the low. People could have said, oh, the 60-40 is only up 4% on the year. Like, look at the run that we just went on. Look at the run that we just went on. We went from up 4% with the year, 85% over to up 13% just a couple of weeks later.
So a lot of people have been saying this year that the bad thing about stocks and bonds is that they're more correlated now, which tends to happen in higher rate environments and higher inflation environments. And that was seen as a bad thing. But now that correlation is a good thing because as interest rates have fallen and stocks took off and bonds took off, you're happy with that correlation in a diversified portfolio. They're working together in concert with one another.
Nothing. I think I lost my other pair of glasses, Ben. So this morning when I left the house, I grabbed one of Robin's old pairs, and I think it looks horrendous.
You can put those back on when you make your 2024 predictions.
I love it, Rishi. There we go.
All right, so that's all on the market. Let's look at some economy charts. let's start with the workers. Are the workers finally getting ahead? This first chart is specifically on employment. So we have the U.S. job openings, which came out yesterday. We have the unemployment rate at 3.9%, and then we have the participation rate at the bottom. Thoughts here?
I like the
Well, Ben,
the
excuse
top
me.
one.
I did major in economics in Queens College, so I think I should go first.
Let's hear it.
I'm only teasing. Go ahead.
No, I think the top one is kind of the story in the labor market is people were asking, like, how come that we have this 12 million open job openings or whatever, and those will fall because a lot of them are fake, and then the unemployment rate will rise, and it hasn't really. Those have fallen off a cliff, and the unemployment rate has just ticked up a little bit. I think that would be actually a positive. I think Powell actually said like that's what he wants to see. I think that's actually a really good thing where you've seen job openings fall, but not really people with jobs fall that much. I think that's so. For your bottom one there, can you, for me, change that to the labor force participation for 25 to 54? So I like how YCharts has the ability to have the different age brackets, because this is, yeah, that participation ratio if you have it. So 25 to 54 is the prime age working population, because the reason that one is more important, I think, is because the labor force itself participation ratio is going to be skewed lower by baby boomers coming out of the labor force as they retire, and many of them in the last few years have retired early because their houses are worth so much more money and their portfolios are, and they went through COVID and wanted to retire early. So this is about as high as it's been. It's higher than it was before the pandemic, and almost about as high as it's been since the early to mid 2000s. So I think this is another positive for the labor force, that people in their prime working years are more of them have come back to the labor force or come back to work.
Rishi, I just want to give you credit. If YCharts is your canvas, you are Leonardo da Vinci.
Appreciate it. I spent a lot of time in here, so. Would you say that means there's a soft landing then, or is this enough to say that, Ben, based on what you said?
I think we've already kind of lived through one a little bit. If you think about it, 18 months ago, people thought the probability of a recession was 100%, basically, when Russia invaded Ukraine and inflation was already at 8%, and it spiked to 9% or more than that. I think the probability of a soft landing has increased a lot. And I think a lot of people are finally realizing, like, oh, wait a minute, we didn't need the unemployment rate to shoot higher to bring inflation down. And that's the first time that's ever happened. It doesn't guarantee one will happen, but I think people are starting to see, like, oh, it's a possibility.
My opinion is that we already landed. And from here on out, if we do go into a recession, it will be from something other than interest rates slowly working their way through the economy. I could be dead wrong. There could be some sort of thing under the surface that is yet to rear its ugly head as a result of interest rates rising. Obviously, I don't know what that would be, but I think we already landed. I think people are afraid to say it because they don't want to have egg on their face, but I'm not afraid to say it. We already landed.
How about this? This is the layover. The first flight is done. That first flight landed. We're in the layover. Now we got to see how the second flight goes and if there's any turbulence.
You know, we should save this good stuff for Animal Spirits. Rishi, you're getting our hottest takes.
Love it.
Only for YCharts.
The other chart we had for this one was, and I'm going to open up a template because, by the way, anyone on this call, you could just go to our templates menu and all these charts we're covering. A lot of them are right here, but the other one we had was just the wages and the impact of wages from inflation. So wages grew by 4% over this time frame at a nominal basis, but the real basis it's a little more flat. Does that concern you at all, or is that what's expected when
I'm
you
the
think
opposite
about
of
wage growth?
concerned. This is very encouraging. We have sustained real wage gains, but average hourly earnings are coming down. So earnings are, it feels weird to talk about earnings from the consumer's point of view. When I hear earnings, I think about corporations, but wages, I'm going to say wages. Wages are positive. but the pace in which they're increasing, like the big scare with inflation was the wage spiral, right? That this just sort of would manifest itself and feed on itself, and that didn't happen. And nobody knew how this would play out 12 months ago. But to me, this is highly, highly encouraging.
Rushi, we keep putting you on the spot here. Can you do the index of consumer sentiment? Because I think this wage stuff, yeah, that top one is fine.
He's like a DJ. He's like taking requests.
So it's obviously very low, and it came up a little bit, then it rolled over. I think if this wage growth number in the middle stays positive on a real basis for a while, and interest rates fall a little bit, so borrowing costs are some relief, I think in 2024, assuming we don't go into a recession, this consumer sentiment indicator could spike. I think this is an early, Michael keeps saying we're using our animal spirits takes here. I'm bullish on consumer sentiment in 2024. I think it's going to rebound a lot.
That's a take. That's an interesting take. I'm going to steal that. Just kidding.
That's my one prediction so far for 2024. I think I'm bullish on consumer sentiment rising. Gas prices down.
I'm going to take the exact other side. The gap between feelings and reality is going to widen further.
Okay. I think if mortgage rates were to fall, gas prices are already down, real wages are increasing as wage growth stays above inflation, I think that's positive for consumer sentiment.
I desperately hope you're right on that, Ben. I'm really tired of talking about how seemingly upset people are. So I really hope you're right on that.
We'll check on that next year when we do this.
But look at that. Wait, go back to that chart real quick if you can. Look at those. The sentiment and wage data kind of tracks each other a little bit. It diverges a little bit, but it went low as real wages were down and falling, which kind of makes sense.
Makes sense. I guess you mentioned gas prices, and that's on this chart, the U.S. retail gas price, but also a few other things that have been impacted by inflation, like the house price index, just general transportation. On the side of inflation and what people are using their money on, is this, what are your thoughts on, I guess, where this data is all headed?
Ben, you had a good tweet today about doom spending. You want to share it?
I said the problem with lower gas prices is consumers are going to have way more money to doom spend. It actually is a good sign, obviously, right? Oil, I think, hit the 60s today, which is another shocking thing to me, especially since the war in Ukraine is still going on, and that was the thing that was going to take oil to 200 or whatever, right? So oil's back in the 60s, and gas prices are falling. That's more money in consumer pocketbooks.
You carry a
time when
and the other thing, though, is it also means potentially consumers are spending more, which this is just a debt overall, like different debt type of indicators. So we're looking at credit card debt, mortgage debt, auto loan, and just the total. These are all at all-time highs. So is that a part of the equation of where people are spending their money?
Rishi, not to put you on the spot again, can you adjust U.S. total household debt by GDP?
Yeah, we can try a ratio. Let's say
a ratio. Ben, while he's looking for that, I still am wearing that fanny pack since we were talking about pocketbooks.
It's good. Fanny packs and backpacks, you're all set. Okay, so this is household debt divided by
some of these.
Yeah, get rid of this. Okay. Is this the max? Yeah. So like we're still deleveraging, as Ray Dalio called it, did he call it the beautiful deleveraging? We're still doing it. So this is a bit of a mic drop, no?
Yeah, this is people have been repairing their balance. People have been repairing their balance sheets since the great financial crisis, and obviously things got way out of whack heading into that crisis. So I think this is still a good sign that people haven't totally got out over their skis. And the other thing I like to tell people, so you have the credit card debt, it's like 1.07 trillion or dollars or whatever, and that round number scares people. But if you adjust that by the 20% inflation we've had, credit card debt is back at like 2019 numbers, 2018 maybe, if you adjusted it for inflation. So I'm really not quite as
Whoa,
worried
whoa,
about
whoa,
debt.
whoa, whoa. Why would, no, I guess you wouldn't adjust. Okay, you would. You would.
People adjust everything for
Yeah.
inflation now. That's what everyone asks for, is adjust this for inflation.
Rishi, could you look at the last 5 years? You know what? I wonder if we could like, there should be nothing to see here. There should be a site where we see real price increases by company. Like, I know my Chipotle is expensive, more expensive, but are they more expensive on a real basis? I don't know. I don't know. Here I am getting mad at Chipotle for raising prices. What if they're just taking the CPI prices and just passing it through? I suspect they're not, but what if they are?
Once we're in the metaverse, everything can be adjusted for inflation on your big screen in your head.
What's next, Rishi?
All right, so next one is housing. Same kind of story here, but this one, I guess, in terms of where the consumer's thinking about this, mortgage rates, they've come down a little bit. What happens if this rate continues to fall? What does housing look like next year?
There's going to be an explosion in activity, and home prices will increase a little bit.
Housing activity is already
Maybe a lot.
picked up. If you look at like year-over-year basis, it's already better, which is surprising a lot of people that it got to 8% housing activity increased. I think people slowly but surely get used to higher rates, and they stop comparing them to 3%. Now they're comparing them to 8%. And so I do think if mortgage rates fall, I think we're going to see way more housing activity in 2024 than we saw in 2023.
Ben, is there any way in the world that lower mortgage rates would increase housing supply faster than demand is waiting? I mean, the answer is no, right? In other words, in what scenario would home prices decrease from here?
It's hard to see it happening in the short term. It seems like it'd have to be a few years down the line, maybe. For me, it's hard to see that happening if rates go from 8 to 6. I think there's been a lot of people sitting on the sidelines waiting for lower mortgage rates, and they're going to say, you know what, I'm sick of waiting. Let's just do it now that rates are a little lower.
I'm with you.
Yeah, we also have this chart here, which shows the just overall inventory of new single family houses sold, and also that home ownership rate as well.
Which is one of the reasons that the housing affordability talk hasn't impacted more people, right? It's on the margin because there's fewer houses being sold and bought, and most people have those low rates locked in, and their housing prices gone up, and they're doing just fine. So that's why the housing affordability thing so far has been on the fringe. And obviously some people are probably upset that they can't move because it's more expensive to move. They'd be paying a higher mortgage rate and they'd be paying more for a house, but they've got a ton of equity. And most people who own their home are in a much better financial position because of it.
Makes sense. All right. The last one here on the economy is the interest rate breakdown. So this is our econ summary deck. Let me just scroll down to the yield curve because that's the one we wanted to cover here. So this is the yield curve from today, from 3 months ago, and then a year ago. Any thoughts on what's gone on and on the like shorter side of it, and also where it is versus a year ago?
I mean, the biggest surprise for everyone, I think, was the long end of the curve shooting up in like a 2 or 3 month period. And now over the last month, it's crashed again. So I think that's the most surprising thing to people, is just how quickly that happened and then reversed.
Is this considered steepening as well, where the short term kind of stayed where it is and the rest of it moved up?
Yes, and I think a lot of people
it's disinverting.
Steepening though, right? I think he's right. But I think a lot of people thought that steepening would happen from the Fed cutting rates and the long end kind of staying where it was, but it hasn't really happened.
My point is, can we call this steepening if it's still inverted? I don't think so.
It's getting steeper.
It's getting less inverted.
Okay.
All right. Let's close out with the big question. What's next? So we don't need to go through, I guess, all of these. I did want to just quickly show this one, Ben, if you had any thoughts on, you had this in your blog post a few weeks ago. What was the point here you're trying to make on generally annual returns and drawdowns and what that means as you're thinking about the markets moving forward?
Yeah, just even when it's up, you're going to experience some corrections along the way. We talked about the 20% thing. I think my number I figured was half of all 20% up years have experienced a double-digit correction along the way, which is kind of what we could experience this year if we end up finishing the year 20%, that you had that 10% correction in October. So even in the good years, you're going to have some give back. One of my favorite charts.
Yeah, and Rishi, this is exactly why that fake Ben Carlson quote was fake about him saying that we don't want a correction. He's Mr. Correction.
Maybe I had it reversed. Maybe it was that there was going to be a correction.
That's true.
That
okay,
right.
Now I think I remember writing that. Yeah, I bet you're right.
All right. Well, speaking of next year, if you had to pick one stock for your kid or for yourself, what would it be?
Michael's better at this than me because you don't want to ask me this question because I bought Disney for my kids 3 years ago or so. And if you look at the Disney chart, I told everyone that Disney Plus is going to be massive. And I was completely right about it. It blew all the subscription numbers out of the water, and the stock has still just been terrible, especially relative to the market. I think it's I don't know. Is it down 40% from the highs still? Something like that? And it's on 55% from the highs.
Yep.
Sorry, kids. No more college.
Two areas of the market that got really badly burned in 2023, really in 2022 as well, that I think might have some legs going into next year, are biotech stocks. The ticker that I would give to you probably is, well, XPI has been a little bit worse. And then clean energy stocks. I actually bought a stock today that hurt me badly a couple of years ago, but I'm back for more pain. I bought Enphase Energy, which is one of the ones that got absolutely destroyed. And definitely, please do not follow me into this. This is a highly risky investment. Needless to say, I didn't bet the farm on this one. But clean energy stocks. You like, what's the ETF? Is it iClean? So I tend to be, if I'm looking out a year, I tend to go bottom fishing, which is very dangerous and not it to be advised. Other than like, I think Uber is going to keep it going. Like that's not where my brain goes if I'm thinking.
So your biotech call is poor performance. So if you look at IBB is the biotech ETF, it was down 14% last year and it's down 6% this year. So you're right, that it's not done very well.
Yeah, it's done horribly.
Makes sense. We'll see. Any other ones? What I know, Ben, you had the Lions not making the playoffs last year, but that one's looking pretty good. Anything else you'd predict for next year?
I'm happy if they win a game this year in the playoffs. That's all I ask for. It might not happen.
I logged my FanDuel account the other night, as I do most every night, unfortunately, and I saw a big spike in my balance. I was like, "Oh, what's this from?" And I guess the Jets are mathematically eliminated from the over-under. I bet the under. It's kind of crazy if you look back. The Jets over-under was 10.5 wins. And my thought was like, yeah, sure. I guess they could win 11 games, but I don't think they're going to. So that paid out. Unfortunately, for every dollar that I had on the Jets under, I had $4 on the Giants over. The Giants over under was 7.5 games, which to me seemed insulting. I was personally insulted by Las Vegas. Well, looks like that one's not going to pay out.
There's
hey,
my
you win
2020.
Some, you lose some.
This is my 2024 prediction I'm most confident about. Michael will lose more money than he'll make in his FanDuel account. Is that fair?
That's a very good. That's a very good bet. That's a very, very good bet. So in my head,
you have to keep us updated on that.
It's entertainment. It's like a vacation. Like I will spend this much money a year on entertainment Because otherwise, I'm not watching the Jaguars lose to the Bengals in a crushing way. But I bet on it, so I'll watch it.
For sure. All right. Well, let's
That's
look
the
at the Q&A
patented
here.
Ben head nod. I'm done with him. All right, let's get to the Q&A.
Let's look at the Q&A. Maybe we could grab a few of these questions and then wrap up here. Let's see.
Someone here asked, what advice do you have for a family member who is a gold bug to talk them off that cliff?
Cannot be done.
Well, or tell them to right size the position. If they really believe in gold, I don't know, put 20% of your portfolio in it and diversify it with other asset classes just in case they're wrong.
My stepdad, in I guess it was 2016, wanted to buy silver, and I was like, why? Like, what commercials are you listening to? Why do you want to buy silver?
But what's like the permanent portfolio? Isn't it 25% gold and 25% treasuries and 25% cash and 25% equities? If you're really that into gold, like I would do something like that and rebalance it, and then gold's still a big piece of your portfolio, but not everything.
I can get behind that portfolio. I think there's nothing wrong with that. Nothing wrong with that at all. If it's boring and it's hard to stick to like everything else, but I think that is a perfectly reasonable investing philosophy if you're of that mind.
Here's a pretty good one. When will the economists concede that sufficient time has passed that the inversion of the yield curve in 2022 did not predict a recession? Can you pull that one up, Rusha, real quick? So it's
Thank you. That's a great question.
There's got to be some minus
there's got to be some sort of statute of limitations, right? I don't know where the line is, but to me, I think we about passed it.
Okay, there you go.
Maybe
10
this
year
is a
versus
good one.
2. So when did it first invert?
Pretty much around like July 2022.
Okay, so it's been a while.
Almost a year and a half.
And a lot of times people will say, well, the recession starts an average of 16 months after the inversion or something like that. And I think that's what people hang their hat on with this one. But it does feel like the Fed caused this to happen. It wasn't like an economic thing that caused this inversion to happen. I kind of agree. You can't say the yield curve predicts this if this is going to happen.
Makes sense. And then one more I see is just referring to the asset class or asset return quilt. Is there what would the case be for international equity allocation towards a portfolio?
I got two, and they're two sides of the same coin. One is look at the dividend yield, or just using it as a valuation proxy. Look at the forward earnings or the earnings yield, and if you compare it to the S&P 500, and this has been a losing proposition for the last decade, but I mean it this time. These things are almost historically cheap compared to the United States. And if there is a 493 resurgence, if value does return, international stocks are going to do just fine. So it's hard to say there's a margin of safety because when equities, there's really no such thing. But a lot of the bad news is baked in. Who is bullish on international stocks? Raise your hand. Exactly.
It's also a currency thing. If the dollar is weaker, international stocks tend to do better, and the dollar's been very strong. And I know a lot of people talk about the dollar crashing for years now, and it hasn't happened. But if the dollar is weaker, then that's usually good for international stock returns as well. So it's almost a currency hedge as well.
Rushi, how do we do? Did you have fun with us?
This was a lot of fun. Time flies. I can't believe it's the top of the hour already. So thanks for rolling through those. This was great. Hopefully everyone on the call really got a lot out of this. Like I mentioned, you'll get a recording of this too. Feel free to sign up for a trial too of YCharts. I know Michael and Ben love our tool, but you guys, I'm sure, will love it too. So you'll get a 20% discount if you sign up for YCharts. Just mention you mention Animal Spirits, and we'll give you that discount to get started. So Michael and Ben, thanks a lot. Appreciate the time, and happy holidays if I don't talk to you.
Thank you, and thank you to everyone who tuned in, and happy holidays to you as well.